Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to go through, what happened with the numbers this week. We were pretty spot on with what we expected was going to happen from last week into this week. And then we want to look at what do we expect going forward. We're coming to a period of really kind of peak demand as we get into the end of July and then progress through August. And we also want to look at what happened with the OPEC deal and what do we think that means going forward, just given some of the shifts in baseline that we've seen over the same time period. So one of the things that we wanted to point out was the imports exports. So as we were saying, there was going to be that big kind of makeup number because the imports were a little light, exports were overstated. And now that we've had some of this flip, we think that you're going to see a bit more stability at the levels that we've been discussing over the last couple of weeks. And then when we look at products, we remain really kind of the best place in a terrible area to bring products. So when we look at products, we have more imports coming from Saudi Arabia. Gasoline imports had a big spike driven by both PADDIII and PADDIII. And we want to look at what are some of the dynamics that are going to continue to happen because, the imports of gasoline will remain elevated, even though we still continue to see, fairly lackluster gasoline demand versus expectations. When we were talking about where we thought some of the expectations were going to be, we were saying that 9.3 is kind of that average. And then, we expect to be somewhere between 9.2, 9.4, depending on the week, and really kind of shaking out right around there. So that's where we shook out again. And as we were saying, diesel was going to see some of that recovery. We got that. We're now back to that 5-year average. And then jet fuel continues to just go sideways. We did a big breakdown in last week's insights. For clients, just make sure to read that because so far, things have been progressing in the way we've been highlighting. So now just jumping right into where things are on the DOE crude oil inventory, you can see that we've essentially had that bounce. And when you look at 2017, when you look at 2019, you can see that we typically have this adjustment and where you get this build that is really not, I don't want to say it's surprising because it is surprising in one way, but at the same time, we've had it in previous years. When you look at what happened in 2016, it's typically what happens when we get overweighted on one side. Spreads all of a sudden make a bit more sense, and you get this adjustment where crude oil inventories actually start to increase instead of decreasing. And we had builds that happened in PADDIII, but more importantly in PADDIII, which is the one that we're going to talk about in a bit more detail. So when we look at what's happening, one of the things that we've been talking about is that we expected to continue to see on average crude draws, but it's that the pace of them is going to slow. And that's what we're continuing to see, where on average, especially when you look over the course of July, we're going to average a draw, but this is going to adjust what that pace looks like, which is what we've been highlighting and trying to point out. And that's where, when you look at crude supply, you can see, as we were talking about, things are starting to flatten out. And this is where we continue to see some of these adjustments with this, really the smoothing out the line and really coming in and kind of flattening back out. And we expect to rise a bit sooner than I think what is expected in the market, purely because production is increasing. You're seeing refiners that are running a little bit slower. You're still seeing demand that is really not getting back to where it was in 16, 17, or 18, or 19. And that's where you're starting to see these adjustments. Plus, when you look at the refining side, there's a lot of product available within the open market. So why am I going to increase my runs where I can try to play the international market, manage the runs within the U.S. And realistically, when you look at what's happened, as we said last week, there was a big increase in purchases from West Africa, and we'll show why. Because we did get a big spike in floating storage. And these are some of the things that are really adjusting when we look at what has happened in West Africa and where some of these numbers continue to go. But Dubai continues to trade at a fairly wide discount versus the other markets. And we continue to see places like China picking up additional cargoes from the Middle East instead of from West Africa, and more importantly from ESPO or Russia, when you look at just where some of the slowdowns have really come in over that same time period. So then when we look at crude storage and products, you can see that we've flatlined and we're actually starting to curl back up. And when you look at just some of the demand at this point, our view is when we net everything together on products and crude is that we just go sideways. And when you look at that sideways move, it just means that the comps are going to get easier. So the numbers will look a little bit worse, but it's just because we typically tend to see a fairly steady draw. Now, when the view is what's going to happen into August. So we had a build in crude. We expect a crude build to pivot into a product build. We expect to see some of a makeup number in gasoline, because when you look at gasoline storage, there was a drop, but there was a fairly sizable build in blending stocks, and that's going to be some of that flipping that we want to look at to understand what are some of the dynamics, and we'll go through that in segment 2. Gasoline storage, as we were saying, still remains elevated, still going sideways. And we expect it to remain in this range just because we do have more imports. They did surprise us to the upside. This is one of the things that we were saying was going to see some of that decline. Instead, we had another big spike. And the issue is always going to be PADDIII in terms of timing of some of that product coming into the market. And just what is that timing? Because there is a huge backlog that is only getting worse. And it's another thing that we're going to touch on in segment 2. And then when we look at distillate had a small draw, which, when you look at some of the lumpiness overall, it's really the trend. And as we've been saying, distillate is pretty much is really in a very steady state. Like there's not too much that is bullish or bearish. It's just kind of where it is. It's moving in a very good direction. The issues really remain around gasoline and jet fuel when you look at some of the blends and some of the backdrops that we see going into the remainder of summer and then progressing into the end of the year. And here's what we've been talking about with jet fuel of just going sideways, where there's really not, we're kind of stabilizing on a demand side. We're starting to see some slowdowns in new departures. We're really past the peak of where we see TSA travelers, and we'll go through that in more detail. And it's really coming into where we were talking about that we were going to get a seasonal increase as we did, but it was still going to fall short of 2019, and we were going to just go sideways and then start to roll over and see those adjustments, which is really what has been transpiring. And you're starting to see that kind of hold firm when we look at what the departures are going to look like as we progress through the next 11, 12 weeks. You can see on the crude curve, even though WTI is up over $3 right now, that we're still off those highs that were reached during that Monday after July 4th. And you can see that there's been some steepness that's been put into the curve, especially when you get to the long dated, just as we've fallen below $55 and $55, and it's really being driven by some of the recent agreements with OPEC. And we'll talk about this in more detail when we start going through some of the different capacity and baseline additions that are expected. Really, I think it's May of 2022 is when they're going to start working on that. And then the cuts will go off of that because they're going to extend it through the end of next year. But we're going to want to go through that in more detail just because there's some caveats and it's a little convoluted. So we'll try to make sense of it. And obviously things are always changing and adjusting. So we're always going to stay fluid with what's happening in OPEC. So then when we look at COVID net changes, this is just looking at case count. So when we look at case counts, you can see that the U.S. has peaked up a little bit, Europe, the U.K. as well. And then when we look at Asian Pacific, as India continues to see a fairly steady decline, South Korea, Japan, Thailand, Malaysia all see those increases in general. Now, the one I want to call out the most is really the UK, because there is the Delta variant there, but this is looking at case count. And realistically, we also need to factor in hospitalizations and deaths. And when you look at the big divide where case counts are increasing, but hospitalizations are staying flat to down, it's really just showing the effectiveness of the vaccine, where the vaccine's not going to keep you from getting it, or hopefully it does. But if you do get it, it'll be a very more mild version and doesn't require the same hospitalization, ICU. Just it protects some of the infrastructure, and at the same time, just think of how evolution takes place. If you kill the host, you're not going to spread and propagate the same way. So when you look at just the way things have evolved, the more contagious but less deadly is always going to win out, because that's going to become the more prevalent gene and the more prevalent backdrop. So that's something that we just also want to consider as we look at, because we're up to Lambda. This is a coronavirus, so they do mutate. So what is that next mutation going to look like? Now, there's easily a mutation that could become more deadly, but typically that's something that's going to be isolated, especially when you look at some of the way these have traveled in the past. So that's just one thing to look at, where case count can be used or manipulated or talked about in a very specific way. And it's good to understand it, but only if you're putting it in connection with, well, what are hospitalizations doing? Because there's usually that 2-week delay. And, just based on, you can see where we started on that UK increase, we're at a point where we should start seeing that in hospitalizations, and we're just not, which is a net positive. So now breaking down the crude draws, because the crude build, it's important to talk about, some of the different factors. And the reason why I say that is because, some of the headlines are saying, well, the build was driven by PADDIII, so we have to kind of ignore the build. And it's like, well, that's not the case, because PADDIII is an isolated entity. They try to work within themselves, and it's the Rocky Mountains is obviously a mountain range, and there's not a lot of pipelines that go over it. So there is a certain amount of bifurcation, but we have to look at this holistically, because there is a certain amount of communication that can happen across different pieces of the PAD entities. And the only reason why I say that is because it was in an article that I just thought was fairly absurd. But when you look at PADDIII had a nice draw. Cushing had a draw of 1.35 million, coming right into essentially the 15-year average. And this is one where we did have a role where we have some settle and physical, and now it's a matter of somebody clearing out, because we do have an increase in production. As we were saying before, the EIA is estimating at 11.4. We think it's a little bit higher than that, just given where our estimates are, and we've been fairly spot on to this point. PADDIII had that increase of 1.77 million barrels a day. 1.77 million barrels. That's 4.2 million below the 5-year average, but we see that continuing to climb higher. PADDIII had that reversal, an increase of 1.9 million. That's 8.6 million below the 5-year average, but still very much elevated versus some of the other time periods, and we'll talk about that in more detail. And that's going to be the one to watch, because we still see some headwinds to the export market as WTI, especially given where the spread is now. It's still keeping it from getting moved into the export market, and that's going to be a little bit of that hindrance, as we do see those imports that are going to continue to filter through, just given they've already been purchased, and refiners are looking to get a little bit heavier, because if we look at gasoline, there's a sizable amount of gasoline in storage, and they need to start adjusting some of this to pick up some of this distillate, pick up some of the heavier side. So that's where we think the API, what is being run as feedstock, is going to adjust heavier. So you'll see a little bit of a decline in gasoline production and an increase in distillate production. And we typically start to see this pivot this time of year. It's a little bit early. Typically it's closer to the middle of August, just because then you start preparing for heating oil season, and you start shifting for turnarounds, and those are things that we typically see, and it's just happening a bit earlier than what is on average. So now when we look at land storage, stockpiles fell 8.2 million barrels last week to 612.7 million. And that's after rising a small amount of 600,000. So now when we look at this week, you had Europe that had a build of about 4.5 million, the US a build of about 2 million. So this is what I was saying, where we're still going to get that net draw. It's just the slowdowns have increased, especially when you look at west of Suez, as east of Suez continues to see those builds, as it's trending to the top end of the 5-year average. And that's where we continue to see the issues with demand, which is putting more crude in storage. China just issued a few more tenders, but they've already started to see a steady increase of what's heading into their market. And we really are seeing a bigger slowdown from Chinese buying as we get into October, November, just because they've already purchased a lot of their crude. They did it before some of the run up. They were taking advantage of some of the spreads, because even though West Africa has increased some of their OSPs on paper, behind the scenes they're still trading at fairly steep discounts, and that's some of the things that some of the companies and countries are trying to take advantage of. So again, those are some of those nuances that we continue to see getting moved into the market, which is why we think that we're still going to hold this average. And it's really just because west of Suez is starting to flatline a bit, and the east of Suez remains elevated. And this is when we look at floating storage. So stockpiles grew about 1.8 million, and this is just looking at kind of where the backdrop is. Here you had east of Suez that came down a bit. There's going to be a little bit of a recovery. West of Suez, as we've been saying, is just flatlining a bit and starting to creep up. And you can see that we're still above that average, obviously well below 2020, but we're still coming into a fairly difficult period. And now that we've seen a bigger shift of crude into storage in transit, so then transit is going to become one of the big components of storage on the back end of it, as we continue to see some of these increases of imports coming from Nigeria and other areas into the U.S. So I think another important piece of the pie is obviously global mobility. So China continues to be at about 95% of normal. That's something that we think is going to be persistent. Europe is the one where we're seeing a big drop. And you can see that it started to roll over in let's call it, the beginning of July, and it's only accelerated. And one of the things that we keep talking about is, even though COVID, the Delta variant isn't resulting in more infections, more hospitalizations, people still don't want to go into an undue risk. They don't want to go into something where they could get it, might get it. They'll just avoid, and that's something that we continue to see in general across Europe. As some of the issues again, it says North America, but it should be the Americas, as we continue to see problems in Latin America, arising, keeping things fairly flat. And then in North America, or I should say in the U.S., you're starting to see a little bit of a slowdown in activity. Nominal at best. It's not something that is huge, but it's just something to keep in mind. And then rest of Asia is really flatlined, because every time we see a country getting a little bit better, another one goes into some sort of restriction or lockdown or an increase in COVID cases that is making some of these adjustments, and they just don't have the same vaccination backdrop that the U.S. and some of these other nations have, which again is keeping them a little bit more hesitant on some of these reopenings. So then when we look at PADDIII, here you can see we had a build in PADDIII. It's not, this is what we've been talking about. It's not crazy to see it when you look at 2017, when you look at 2019. There's always a little bit of lumpiness, especially as we come into the end of July, into August, because the question is always, buying ahead of time, seeing some of these increases, and then you see one more push down, as we saw, especially in 2017, because this crude is going to become product. So that's why we always look at it separately and then together, because we want to look at what is demand shaping up to be, how is that deviating. And again, we continue to be in a very normal market, which and even a little bit less bullish than the market or price action would tell you, in terms of where some of these backdrops are and where things are setting up into the end of the summer. So this is the bullish side of it, where we continue to see Cushing moving lower, coming back into that 15, a little bit over actually, at that 17-year average, when we look at just where it sits, where you had that nice drop down, but now that we look going forward, this is something where we should see some of these paces adjust, and we should actually start seeing some builds get priced into the market as we see some of these adjustments. And again, it's going to be driven based on production coming online, and then also the shift of coming from Cushing down into PADDIII. As exports slow down, this is again going to push back and keep some of this crude up in Cushing. So then when we look at imports, this was some of this makeup number that we were discussing, where we had an increase of 874,000 barrels a day, getting to about 7.1 million barrels a day of imports. That's still 288,000 below the 5-year average, but that's really skewed because when you look at PADDIII, it was only an increase of 8,000 barrels. PADDIII should see a bit more of an increase, as they're 117,000 below the 5-year. But again, that's going to take time. The Midwest was fairly flat. It was only down by 1,000 barrels, which is essentially a rounding error, and that remains elevated and that's 213,000 above the 5-year. The shift is really in PADDIII. So PADDIII starting to get back to normal, starting to claw back some of those, some of that slowdown with an increase of 292,000 barrels a day. That's still 721,000 below the 5-year average. And we don't expect to get to the 5-year average, but we do expect to see some of this stickiness where, maybe next week, or I should say this week into next week, we don't see another 200,000, but rather just starting to see some of this stabilization, where we're going to continue to see some of this elevated imports, and then we'll start walking up on that higher baseline into PADDIII. PADDIII is always lumpy. That was an increase of 349,000. PADDIII is the one where what we were saying last week. We had an increase of 226,000 barrels a day. That's 139,000 above the 5-year average. We continue to see that remaining elevated, but that's where we're going to see more of the lumpiness. So PADDIII, we expect to see a bit more stability with a more consistent import number. PADDIII is the one that's going to see that lumpiness due to not only just demand and operations of refiners, but also just because of the massive backlogs that are hitting that whole region. Now, some of the other components, so July loading shipments of clean fuels from Asia to the Americas rose to 280,000 tons from 210 tons. Volumes will be double of those in June if all tankers end up coming from South Korea, coming from Japan, and now also Saudi Arabia is increasing flows of gasoline to the West Coast with 2 cargoes, with a combined 500,000 barrels of fuel arriving the past 2 weeks. So again, New York Harbor just took 1, so we're continuing to see a lot of these elevated moves of products into the U.S. So then when we look at runs were down by about 0.4%, 40 basis points to 91.4. We're still right in line with that kind of 5-year average. We don't see it moving all that much. We were expecting maybe a peak of 93%. But right now we're continuing to see some of these slowdowns. So it's gonna be hard to see these refiners kind of gun that to 93%, because typically as we start to get into August, you start to see some slowdowns. And it's just based on storage. And when we look at gasoline, when we look at some of the elevated numbers, there's less of a reason to increase over the next couple of weeks, which is not to say that we can't get to 92%, because we very well can. It's just that 93% now looks a little elevated and probably very unlikely. I shouldn't say very, because anything's possible, but unlikely given where we sit right now. PADDIII is still fairly flattish, about 319,000 below the 5-year average. PADDIII still running strong at 198,000 barrels a day above the 5-year. But PADDIII is the one where we saw a little bit of a catch-up increase, an increase of 31,000 barrels a day, very close to the 5-year average, and 85,000 below the 5-year, which I think is a very doable number. Now, PADDIII is the one that is 79,000 barrels a day below the, is 260,000 barrels a day below the 5-year average, and a decline of 79,000. That's where we'll see a little bit of an uptick, and that'll be supportive of some of the numbers, but we're just not going to get and close that gap that we normally have on the 5-year average level. So then when we look at implied demand, as we were saying last week, we expected gasoline to come in right around these levels. It came in at about 9.295 million. It was an increase of just 12,000. DISTI was the one that we thought was going to see a big jump. We got it, 761,000 barrels a day. Still below the 5-year average, but again, getting closer to where we think we're going to be over the next few weeks. And then jet fuel had that typical kind of shift down. Just living within this, what we'll call a chevron pattern sideways of, peaking at about 1.5, coming down to as low as 1.3, and just going sideways, averaging about 1.4, which is right there. Resid, something similar. We have a lot of shipping activity, so this is going to be something that should be a bit supportive. Propane, this is going to be lumpy. Decline of 332,000 barrels a day. That will rebound next week. But the one that was interesting is the other oils, where other oils was up 723,000 barrels. And this is what we want to touch on briefly, because there's an ability to recrack, and there's an ability to do things with some semi-refined products and some other assets just to try to increase margin. And this is where, when we look at other oils, we have to look, which is why we talk about blending stocks and some of these other things, because maybe it makes sense to not import as much oil and try to take some of this product and turn it into something more specific. Naphtha, taking some of the middle ends and running it through an alky unit, a reformer, and creating something different. So even though this other oils implied demand, you could say, skewed bullish, it's also being used to meet some of the other products, which is when you start looking at what the storage is and how some of these runs have come down a bit, but other oils demand is essentially replacing it. And that's where we want to look at, because if you go back to the refinery run rates, the utilization rate is down, but the crude being run is elevated, and that's where we want to look at some of the nuances that can come in. And then, not to get too technical, because there's all types of adjustments, but that's something to consider in general. And then European gasoline arrivals into the U.S. was increased 57% week over week in the week through July 15th, just based on, again, some of those increases that we've seen coming from Europe, and just they were already in the water. We expect to see some of that slowdown in general, but it is a rebound, which also increased some of the levels or the import numbers coming into the U.S. So when we look at floating storage, as we were saying, it's continuing to creep higher. We expect it to get into the bottom of the cloud. And if you just look at on a seasonal level, seasonally, we're normally coming down and drawing that down. Instead, it's going back up. So the comps are getting a bit easier, and we expect to fall within the bottom of that cloud over the next 2 weeks. And this is one of the drivers. So when we look at imports, as we were saying, we were going to fall back within the bottom of the cloud, getting closer to a peak in imports. And we think that imports are going to continue to creep higher and stay, again, not coming to the 5-year average, but still just escalating and elevating itself. The pace of builds of imports are going to slow a bit, but you're still going to see a net increase over the next couple of weeks. And when you look at PADDIII, as we were saying, we expected it to go sideways. If anything, there'll probably be a little bit of a drop, and you can see that normally happens on the 5-year, but nothing crazy one way or the other. It's still going to stay strong. It's still going to stay above the 5-year. PADDIII refiners are still running fairly above where they were, even though product builds are increasing in PADDIII, which is going to result in some slowdowns of refinery throughput. It's just we don't think that's going to happen yet, or really it's not going to happen over the next week or two. That's something that we expect to see much closer to August, where we think we could see a bit of an accelerated reduction. But again, we're going to have to look for some of the pieces, but that is something to watch, especially in PADDIII. And then when we look across the last 29 years, you can see we're falling below the average. the average overall is closer to, again, that 93.5%. Instead, we're sitting here at about 9.4. So there's still some opportunity to close that gap. It's just we're getting a bit long in the tooth because as we get into August, again, we start to see some of those reductions. So those are some of the key pieces that we're looking at. And now in the next segment, we're going to go through in a bit more detail what's happening within the specific refined products and what do we expect to happen over the next couple of weeks.